Imagine it's 1965. You're a 28-year-old production line supervisor at a General Motors assembly plant in Dayton. You wake up at 5:30 a.m., kiss your wife goodbye, and drive your Chevrolet Impala to a job you've held for 6 years. Last spring, you bought a 3-bedroom house on Smithville Road for $14,000. The mortgage payment is $89 a month. Your wife doesn't work. She doesn't need to. You have 2 children, and she stays home to raise them. You're putting $40 a month into a savings account at Winters National Bank, earning 4.5% interest. You're building something. On Saturdays, you take the kids to the hardware store and work on the house. By the time you're 55, the mortgage will be paid off. By 65, you'll retire on a pension that replaces 70% of your income, plus Social Security. You'll own your home outright. You'll fish. You'll visit the grandchildren. You did everything right, and the system rewarded you for it. Now imagine it's 2024. You're 28 years old, a logistics supervisor at an Amazon fulfillment center outside Dayton, Ohio. You make $58,000 a year. Adjusted for inflation, that's less than what the GM worker made in 1965. You rent an apartment for $1,400 a month. You have $23,000 in student loans. Your savings account earns 0.5% interest, well below the rate your money is losing value. The house on Smithville Road, the same house the GM worker bought for $14,000, sold last year for $289,000. You've done the math. To buy that house today with a standard mortgage, your monthly payment would be over $2,100 before taxes, before insurance. That's 43% of your gross income. The old rule was 28%. You'd need to earn almost $90,000 a year to afford what a factory supervisor bought comfortably in 1965. You're working the same job, in the same city, with the same responsibilities. But something changed. Not your work ethic, not your education, not your discipline. Something deeper changed. Something structural. This isn't about personal failure. It isn't about avocado toast, or poor financial decisions, or not working hard enough. What happened to the American middle class wasn't an accident. It wasn't even primarily about globalization or technology, though those played a role. What happened was a slow, invisible mechanism built into the architecture of modern monetary policy. A mechanism that systematically transfers wealth from people who earn money to people who own assets. A mechanism so quiet, so gradual, that most people never notice it operating. Once you see it, you can't unsee it. This isn't theory, it's documented monetary history. It's in the Federal Reserve's own data, and it couldn't have ended any other way. Let me show you how it works. If you ask the average economist or politician or financial commentator why the middle class has declined, you'll get a familiar set of answers. Globalization, jobs moved overseas, automation, robots replaced workers, education gaps, people didn't adapt fast enough, poor financial choices, people spent too much and saved too little. These explanations aren't entirely wrong, they're just incomplete. They describe symptoms, when they don't describe the mechanism. Here's what most explanations miss. Wages, in real terms, have barely moved in 50 years for the median American worker. Meanwhile, the prices of the things that define middle-class life, housing, healthcare, education, childcare, have increased by 300%, 400%, sometimes 1,000%. If wages stayed flat and prices exploded, the math is simple. The middle class didn't fail. The math failed them. The question is, why did prices explode? The answer everyone gives is inflation. But that word is too vague. Inflation is a symptom, not a mechanism. The question isn't whether prices went up. The question is, why do prices of certain things, specifically assets and services that the middle class needs, rise so much faster than wages? The answer is a concept that almost no one is taught in school, a concept that has a name but no political constituency. It's called the Cantillon Effect, and it explains almost everything. In the early 18th century, an Irish-French economist named Richard Cantillon made an observation that still haunts modern economies. He noticed that when new money enters an economy, it doesn't enter evenly. It doesn't land in everyone's pocket at the same time. It enters at specific points, typically through banks, through government spending, through financial institutions, and then it spreads outward. The people closest to the entry point get the new money first. When they spend it, prices haven't risen yet. They get to buy assets, goods, and labor at yesterday's prices. By the time the new money reaches the average worker, through wages, through the general circulation of currency, prices have already adjusted upward. The worker gets the new money last, but pays the new prices first. This is not a small effect. Over decades, it's catastrophic. Think about what happened after 2008. The Federal Reserve, in response to the financial crisis, created over $4 trillion in new money through a process called quantitative easing. They didn't print cash and hand it to citizens. They created digital reserves and used them to buy financial assets, primarily treasury bonds and mortgage-backed securities, from banks and financial institutions. The new money entered the economy through Wall Street, not Main Street. What happened next was predictable. Banks didn't lend that money into the real economy at the rate policymakers expected. Instead, the money flowed into asset markets. Stock prices rose, bond prices rose, real estate prices rose. By 2021, the S&P 500 had more than quadrupled from its 2009 low. Who benefited? People who already owned stocks, people who already owned real estate, people who already had access to cheap credit, institutions that could borrow at near zero rates and buy income-producing assets. Who didn't benefit? The median American worker, the young person trying to buy their first home, the family putting money into a savings account that earned 0.1% while inflation ran at 2%, 3%, sometimes higher. This is an opinion. It's in the Federal Reserve's own distributional data. In 2010, the top 10% of Americans owned about 67% of all household wealth. By 2023, that number had risen to over 77%. The bottom 50%, half the country, owned 2.6% of all household wealth. Let those numbers breathe. Half the country owns less than 3% of the wealth. And that didn't happen because half the country suddenly became lazy. It happened because the mechanism of money creation funneled new purchasing power to asset owners and diluted the purchasing power of wage earners. Every time the Federal Reserve creates money and injects it through financial markets, it performs an invisible transfer from those who hold currency and earn wages to those who hold assets and access credit. It's not a conspiracy. It's not intentional malice. It's the architecture of the system operating exactly as designed. Let that sink in. Here's something most people don't realize. The Federal Reserve explicitly targets 2% annual inflation. This isn't a secret. It's official policy. They announce it. What they don't announce, what no one explains in plain language, is what 2% inflation actually means over time. At 2% annual inflation, your money loses half its purchasing power in approximately 35 years. If you're 30 years old and you put $10,000 into a savings account today, by the time you're 65, that $10,000, if it earned nothing, would buy what $5,000 buys today. But wait, you say, I'm earning interest. True, but for most of the last 15 years, savings account interest rates have been far below the inflation rate. You weren't earning. You were slowly losing at a rate just gradual enough that you didn't feel it year to year. This is the trap. When interest rates are held below inflation, a condition economists call financial repression, savers are penalized. Every year, their stored labor loses a little value. Not enough to notice month to month, just enough to compound into devastation over decades. Meanwhile, borrowers are rewarded. If you can borrow at 3% and inflation is running at 4%, you're effectively being paid to take on debt. The real cost of your debt is shrinking. The question is, who has access to cheap debt? Banks, corporations, private equity funds, wealthy individuals with collateral? Who doesn't? The median worker, the young family, the person who did what they were told. Live below your means, save money, be patient. They were playing by rules that no longer applied. If this sounds new, it's only because schools don't teach it. The pattern is ancient. In the late Roman Empire, a similar mechanism operated. The imperial government, facing endless military costs and administrative expenses, didn't raise taxes explicitly. Instead, they debased the currency. The silver content of the denarius, the standard Roman coin, fell from over 90% in the 1st century to less than 5% by the 3rd century. What happened? Prices exploded, but not evenly. The people closest to the new money, government officials, military contractors, connected merchants, spent the debased currency first. By the time the wages of ordinary workers caught up, prices had already adjusted. The Roman middle class, the small farmers, the artisans, the shopkeepers, were slowly crushed. They sold their land to wealthy estate owners. They fell into debt. Many became tenant farmers on land their grandparents once owned. The great latifundia, massive estates owned by the Roman elite, grew and grew while the independent farmer vanished. This wasn't moral failure. It was monetary mathematics. In Weimar Germany, the mechanism operated faster, but with the same structure. The government printed money to pay war debts. The new marks entered circulation through government contractors and banks. By the time workers received their wages, prices had already moved. People were paid in the morning and spent by noon because by evening their money bought less. The middle class was annihilated. Their savings, denominated in marks, became worthless. Meanwhile, those who owned real assets, factories, land, commodities, retained their wealth and often expanded it by buying the distressed assets of the ruined middle class. This is the pattern. Currency debasement does not destroy wealth evenly. It transfers wealth, from savers to debtors, from wage earners to asset owners, from those who play by yesterday's rules to those who understand today's game. In America, the mechanism has been slower, more gradual, more invisible, but it is the same mechanism. Since 1971, when President Nixon ended the convertibility of the dollar to gold, the U.S. money supply has expanded by over 4,000%. The median home price has risen from $24,000 to over $400,000. The median male worker's real wage has risen by less than 5%. Those numbers tell the story. The money supply expanded. Asset prices followed. Wages didn't. That's not a coincidence. It's the Cantillon Effect, operating over decades. Here's where the analysis becomes uncomfortable. No one sat in a room and said, let's design a system that slowly drains the middle class. That's not how it works. What happened is more subtle. The system evolved to serve the incentives of its operators. Central banks, beginning in the 1980s, adopted a framework focused on price stability and employment. On paper, this sounds reasonable. In practice, it meant one thing. Whenever there was a financial crisis, the solution was to lower interest rates and inject liquidity, to bail out the financial system, to prevent asset prices from falling. This created what economists call moral hazard and what traders call the Fed put. If you're an investor, you learned that the Federal Reserve would step in during crashes. If you owned assets, you were protected. If you were short the market or sitting in cash, you were punished. Over time, this reshaped the entire economy. Capital flowed into financial assets rather than productive investment. Corporations borrowed cheap money not to build factories, but to buy back their own shares. Private equity firms loaded companies with debt and extracted fees. Housing became a financialized asset class rather than shelter. The incentives were rational. The rules of the game had changed. The people who understood the new rules, bankers, fund managers, real estate investors, prospered. The people who kept playing by the old rules, work hard, save money, don't take on debt, fell behind. This isn't conspiracy, it's adaptation. The system rewarded asset accumulation and punished wage-based savings. People responded to incentives. But here's the key point. The Federal Reserve doesn't answer to the middle class. It answers to Congress, which answers to donor classes, which are disproportionately made up of asset owners. And it answers to the financial system itself, which it was created to stabilize. When the choice comes, protect asset prices or protect purchasing power, the Federal Reserve, historically, protects asset prices. Every time. 2008, 2020, every time. The mechanism has a political economy. It's not neutral. It has beneficiaries. Now we reach the part no one wants to discuss. The mechanism can't be easily reversed. It has created its own trap. Here's the math. The United States federal government owes over $34 trillion in debt. The interest on that debt at current rates is approaching $1 trillion per year. That's more than the defense budget, more than Medicare. If interest rates rise significantly, back to historical norms of 5% or 6%, the interest payments on the national debt would consume an ever larger share of the federal budget. Tax revenues wouldn't cover it. Spending would have to be slashed, or the deficit would explode. The same trap exists in the private sector. American corporations have issued trillions in debt at low interest rates. American households owe over $17 trillion in mortgage debt. The entire economy is structured around the assumption that money remains cheap. If rates rise, the system seizes. If rates stay low, the mechanism continues. Asset prices inflate, wages lag, the middle class erodes. There is no painless path. The Federal Reserve is not an all-powerful actor. It's constrained. It must manage between two unacceptable outcomes: recession and deflation if it tightens too much, or continued wealth transfer if it stays loose. So far, whenever forced to choose, it has chosen to stay loose. Look at 2019. The Fed tried to raise rates and shrink its balance sheet. Markets wobbled. By 2020, rates were back at zero. By 2021, the balance sheet was bigger than ever. Look at 2023. The Fed raised rates to fight inflation. By 2024, they were already signaling cuts again before inflation had even reached target. The pattern is clear. There's always a reason to stay loose. There's always a crisis. There's always a justification. And each time the mechanism turns another fraction. Savers lose. Asset owners gain. The middle class rung of the ladder rises a little further out of reach. Let me tell you what the data doesn't capture. It doesn't capture the 34-year-old nurse working 2 jobs who still can't afford a down payment on a house in the city where she was born. It doesn't capture the teacher who did everything right, college degree, stable career, 20 years of service, who will retire with no pension and a 401k that won't last 15 years. It doesn't capture the young couple doing the math and realizing that if they want to own a home and have children, they can have one, but not both. It doesn't capture the quiet despair of people who followed the rules and lost anyway. Birth rates are falling across the developed world, not because people don't want children, survey after survey shows they do, but because the math doesn't work. The housing math, the childcare math, the one-income household math that worked for your grandparents is now mathematically impossible for most young families. That's not laziness, that's arithmetic. And here's the cruelest part. The people caught in the trap often blame themselves. They think they should have saved more, worked harder, made better decisions. They don't realize they were playing a game with rules that changed mid-play. The mechanism is invisible. The results are not. In 2020, the mechanism accelerated. In response to the pandemic, the Federal Reserve expanded its balance sheet by over $4 trillion in roughly 2 years. The money supply grew faster than at any point in modern history. Asset prices surged. Home prices rose by 40% in many markets. Stock markets hit all-time highs. Then came inflation. For the first time in decades, consumer price inflation became visible. 7%, 8%, 9%. Prices that ordinary people pay, food, gas, rent, jumped sharply. This wasn't new. What was new was that it became impossible to ignore. For years, official inflation metrics had understated what ordinary people experienced. Housing costs were measured through a calculation called owners' equivalent rent that systematically lagged actual housing price increases. Healthcare and education costs were adjusted for quality improvements that mattered little to the person writing the check. But in 2022, even the official numbers couldn't hide it. The response was predictable. The Federal Reserve raised interest rates, but they raised them knowing they couldn't sustain it. The debt loads were too high, the financial system too fragile, the political pressure too intense. By 2024, rate cuts were already on the table. The cycle continues. But something has changed. People are beginning to notice. Not just economists, not just traders, ordinary people, young people. They're looking at the math. They're asking questions. Why can't I afford what my parents afforded? Why does everything cost more but my paycheck doesn't keep up? Why does the stock market boom while my life feels harder? The mechanism is becoming visible. And when mechanisms become visible, they become political. Here's the question I want you to sit with. If the system is structured to transfer wealth from wage earners to asset owners, if that transfer is built into the architecture of modern monetary policy, then what is the purpose of telling young people to work hard and save? The old formula, education, job, savings, home ownership, retirement, was designed for a monetary system that no longer exists. It was designed when interest rates were positive in real terms, when wages grew with productivity, when asset prices were anchored to income, not liquidity. That system ended in 1971, but the advice didn't change. We're still giving people a map to a city that was demolished 50 years ago. The uncomfortable truth is this. In the current system, the single most important financial decision you can make is not how hard you work or how much you save. It's how early you acquire assets. Those who bought houses in 2012 were rewarded. Those who waited until 2022 were punished. The difference wasn't discipline. It was timing and access to credit. That's not meritocracy. That's a lottery with weighted odds. The mechanism doesn't reward virtue. It rewards proximity to cheap money. Let that sink in. I want to return to Dayton, Ohio. That house on Smithville Road, the one the GM worker bought in 1965 for $14,000, still exists. The neighborhood has changed. The factory closed in 2008. The new jobs pay less. The new workers rent. The wealth that was built by that generation, the pensions, the home equity, the security, much of it has been transferred. Some to healthcare costs in the final years of life. Some to financial products that promised safety but delivered fees. Some simply inflated away, quietly, year after year, in savings accounts that couldn't keep pace. The next generation started from further behind, and the generation after that, further still. This is not a failure of individuals. It is a failure of architecture. The system is operating exactly as designed. It's just that it was designed implicitly, incrementally, through 1,000 small decisions to favor certain outcomes over others. If you own assets, the system works for you. If you don't, it works against you, and the gap widens every year. The question isn't whether this will change. The question is whether it will change through policy reform or through the kind of systemic rupture that no one can control. History offers examples of both. Some societies reformed their monetary systems before collapse. Most didn't. What happens next is not determined by economics alone. It's determined by politics, by awareness, by whether enough people understand the mechanism before it's too late to address it peacefully. The pattern is already in motion. The only question is how it ends. This is historical and educational analysis. It is not financial or investment advice. The purpose of this channel is to study monetary history and its implications, not to predict markets or recommend actions. Understanding how systems fail is the first step to surviving them. If that matters to you, subscribe to this channel and tap the bell icon so you can receive every video.